Hello, this is Mike Swanson, and I run the website WallStreetWindow.com. And the odds are that you're watching this video because you got an email from me telling you about it. Now, if you're not on my email list, click the link you see with this video to join it, because every single trading day before the open, I send out an email with the top things I'm watching in the markets and news stories that I think are important to know about before the market open, and often a chart, an idea, and so forth. And there's a lot of things happening now that I need to talk with you about today and over the next couple of weeks. In fact, I haven't done a video like this for several months. I think the last time was actually back in August, because I kind of took a break. I didn't really think much was going on or going to happen in the markets for a while that would, be important enough to make a video about. But that situation is now changing. And I want to show you some charts that, I think kind of show this. Well, this is a chart of the S&P 500. And, at first glance here, there's nothing really that unusual about it. We had a little dip in November, bounced back up, and actually for a moment last week made a new intraday high. And then the market turned down. That was on a Thursday with some heavy selling, fell a little bit on Friday. And this is the S&P is sitting on its 50-day moving average. Well, as you see from this chart, there's been multiple little pauses and dips like this all year, and really last year too. But I think this dip is different, and that's why I'm doing this video. I think we're going to enter a good chance that we're going to have an actual bear market in the U.S. stock market next year. And I want to show you the one indicator that has me concerned that this is very likely to happen. And then the next indicator, which would serve as confirmation. But first, let me explain what a bear market is in where we are likely now. So I break up a stock market cycle into stages, and you can quickly identify the stage by where the price of the market is relative to the 200-day moving average. In a stage 2 bull market, prices are consistently going higher, and that 200-day moving average is acting as a support level. And it really doesn't matter if you're looking at commodities, foreign markets, or the U.S. stock market. Now, you have a stage 3 top when the market can stay above that moving average, but the momentum starts to falter and the moving averages will flatten out. They still can act as support, but in time, the market will dip below that 200-day moving average. And then you enter stage 4, in which the market, or whatever you're tracking, the ETF, a stock, stays below that moving average, and that moving average then becomes key price resistance. Now, there's something going on right now inside the stock market, which is consistent with a stage 3 top that leads to a bear market. And that is the factor that has me concerned. It started to concern me of a coming top back in June, but now the indicator is flashing not simply a yellow light, but a red light. And let me show you this indicator. This is the percentage of stocks inside the stock market below their 200-day moving average. So right now, that indicator is 46% of stocks trading in the U.S. stock market and the New York Stock Exchange are below their 200-day moving average. That means that 44% 4% or above, 46% below. More stocks are below the turn-day moving average than above it. And more important, I started to get concerned in June because it appeared this indicator was going to turn down. There are a lot of stocks that actually peaked in February. Things such as the ARKK ETF peaked in February. There are a lot of stocks that had big surges in the second half of 2020 that peaked in February. And that was a warning sign. But then in June, this indicator and several other similar indicators started to appear as if they topped out. I actually did some steps in July as a result to reduce the risks in my own investment accounts. I just raised a little bit more cash than I had, and said to myself, okay, we're probably in the ninth inning of this bull market, assuming the bull market, this cycle started in 2020 after a 35% close to decline in the S&P 500. And I don't care about being in 100% invested at the exact peak. But what this indicator has now done in the month of November is the red light. And what it did was it had a rapid plunge in just 2 weeks. And that plunge, you have to really go back to see something similar to August of 2007, which is really the last time the stock market went through, well, there was 2015, the internals, this is an internal indicator, they disintegrated ahead of a 20% decline in the S&P 500. It was bigger in the NASDAQ. But 2007, there was a similar plunge to this that happened in August of that year, which set the stage up for one final rally, which ended in October. And then there is a bear market that began that few people recognized until everything crashed in the fall of 2008. But this is a critical warning indicator saying that, okay, even though the S&P remains above the 200-day moving average, we're deep in a stage 3 top now, because what happens in the topping process is most stocks start to perform worse than the market. They perform worse than the market averages, and that gets worse and worse until everything starts to tip over into a bear market. And I think that what this indicator is suggesting to me is that even though the S&P 500 remains above the 200-day moving average, which is the green indicator on this chart, most stocks are below it than above it. And we're probably in the phase where over the next couple of weeks or month or two, we're going to see the S&P 500 end up below the 200-day moving average to complete the stage 3 top and just start the very beginnings of a bear market. It doesn't mean everything's going to crash overnight. And it doesn't mean there's not going to be stock market rallies in the future. And it doesn't mean there won't be sectors in stocks that just stay bullish or get bullish because of this. I think that's going to happen. And that's the best way to make money when the environment starts to change. But I think we're just seeing the very start of, it's just, we're in this process. And that's why the other thing that happens is market volatility increases, especially it increases during the stage 3 top and picks up as it continues. So in hindsight, 6 months from now, we may be looking at this chart and saying, okay, it looks like the topping process probably started in September on that little dip to the 150-day moving average. Then this was the final rally. And then, you get down below the moving average or retest it again and then have another bounce next year and then so forth. But the risks are growing. And the second indicator that will confirm everything I'm talking about is the cumulative volume advanced decline for the S&P 500. This takes all the advancing stocks during the day, keeps tracking them, comparing to the declining stocks. That's the advanced decline line. But this does something beyond just that. It adds volume to it. So it's a way to track whether there's more actually buying going on in the market, in the volume, or selling. And there's a peak in volume in October. And even though the S&P 500, made an intraday high last week, this indicator is well off the high. And if this indicator breaks down below 15,100, that again will be confirmation to me that the trend is we're going to see a retest or break down through the 200-day moving average over the next couple of weeks. And I'm looking, out over weeks when I'm talking about these things, and really months, not what's going to happen Monday or Tuesday. So that's short-term action. This video is about, where are we going in the first quarter? And I think in the first quarter, we can expect a retest or breakthrough of the 200-day moving average on the S&P 500. And the reality is this has already taken place with a lot of the FAD ETFs. The ARKK ETF is below the 200-day moving average. And in fact, I would say this ETF is already in a bear market. The Russell 2000 is now below its 200-day moving average also. So there's many stocks, sectors, and entire indices that are below the 200-day moving average, while the S&P 500 still remains above it. So this is where the weaknesses in the market, stocks such as Zoom, way below the 200-day moving average, they're leading things down. And what will likely happen is the selling that we've seen in ARK and these sort of stocks will spread, if it didn't start last week, into the S&P, into the Dow, and bring them down too. But this is the stuff falling the most and to be the most careful about. To give you another example, sort of typifying what's going on, the Robinhood stock Hood, this stock briefly touched $84 in August. Now it's below 20. That's a horrible decline. This stock is in a bear market, and there's many, many, many stocks in the same situation. And the leadership in the market, one of the stocks that has done the most to help the S&P 500 is Apple. And, you can see in here, Apple had a nice run in November, but Apple looks like that momentum stalled out last week. And that is going to hurt the momentum of the S&P 500. And that's kind of like, when Apple does that, the upside in the short run is very limited, I believe, over the next couple of weeks for the broad market. Now, we'll have to look at other things, commodities, gold, silver, in follow-up videos. But I just wanted to share with you this situation here with a likely stage 3 top being in a completion phase over the next couple of weeks, the next quarter. That's going to be one of the most important things happening in the financial markets, period. So all that said, hit the subscribe button if you're just watching this on YouTube. That way YouTube will send you the next video, notify you about it, and hit the bell button, and you get the notification, and hit that like button so that I know you are there watching this and do want to hear more. And all that said, I will be talking with you later.